In this video, we are going to be taking a look at financial statement modelling. So we will have a look at how you model financial statements, so forecasting what might happen in a particular entity going forwards. We'll have a look at some biases that might affect that modelling process. And then we'll be moving on and thinking about the forecast horizon. We'll also be having a think about the impact that price inflation may have as well. So, in terms of producing pro forma financial statements, equity investments, when you cover that topic area, will cover this in more detail. But essentially, the first thing you're going to want to focus on is the revenue. So in a sales-based pro forma, you are going to project future financial statements based on an estimate of future revenues. So of course, for those future revenues, you're going to be wanting to think about expected growth. So thinking about the market share of the business, growth in the industry, any trend growth rates for the business in question. Moving on, you'll then have a look at your costs of goods sold, and generally speaking, they are done either as a percentage of sales. So you'd be looking at gross profit margins from previous years, for example, or if you have more detailed information to estimate it more accurately, you may do it that way. Moving further down the income statement, looking at your selling, general and admin costs. These largely are fixed. So by fixed, I don't mean they won't change, but I mean they're not based on the volumes of items sold. So they often are fixed, so you'll need to think about inflation, for example, or any changes you're expecting in those costs. In some businesses, you may find that you do want to grow them in line with revenue, but you'd have to have some specific information to help you reach that conclusion. Financing costs, so that's largely looking at interest. Of course, you'll need information about interest rates, what the debt levels are in the business, whether you expect those debt levels to remain constant or whether you expect changes in the capital structure of the business, so debt versus equity, to occur. As well as this, you might want to have a think about any upcoming capital expenditure. So if you are expecting the business to have a large amount of capital expenditure on assets in the next few years, you'd need to have a think about, do they have enough money for this? Or are they going to have to raise some additional finance? And of course, if they do, then that will most likely incur financing costs. After that, we move on to the tax. Now, of course, the tax expense in the income statement is a combination of the amount of tax that is payable and movements in your deferred tax. So you need to be thinking about the movements in the deferred tax. You'd want to have a think about historic effective tax rates, so the tax rates that have appeared in the income statement in past years and whether they're going to be applicable going forwards. If there's any anticipated change in legislative tax rates as well. Now, once you've completed all of those, so that covers off these first three bullet points. Once you've completed all of those, you'd then be moving on to your balance sheet. And the first thing you're probably going to look at is the working capital items, so the items that flow from the income statement. So your working capital, remember, is your current assets minus current liabilities. So you'd be thinking about things like your trade receivables, you'd be thinking about trade payables, inventory levels, based on the sales and the cost of goods sold, etc., that you have in your income statement. After that, you're most likely to fill in your PPE section based on any capital expenditure that you have estimated will occur, depreciation methods, etc. And then you'll be able to produce the rest of the balance sheet thinking about the financing, so the long-term debt and equity. Once you're happy with your pro forma income statement and balance sheet, you can then use this information to prepare the cash flow statement. Just like you would if you were having a look at actuals, so at the past year or the most current year, and you were trying to produce a cash flow statement, you can use your income statement and balance sheet, thinking about the indirect and the direct method for CFO, for example. The indirect method starts with your net income and makes adjustments based on balance sheet movements, non-cash charges, etc. So you can use your income statement and balance sheet to prepare a forecast cash flow statement. As I said, these will be looked at in a little bit more detail in your equity investments topic area, but it is a good place for us to start having an understanding of what goes into producing pro forma or forecast financial statements. Now we're going to move on to biases that might appear in forecasting here. Now just to be clear, these are going to be biases relating to the analyst who is producing the forecast. When you are looking at your portfolio management topic area, that will look at biases an investor may have with regards to investment decisions they make. So first off, we have 3 on this slide and then 2 other biases on the next slide. So overconfidence. Too much faith in one's own estimates and underestimating the errors that may occur. So as an analyst, having too much faith in the forecasts that you have produced. This is more common if actually the analyst goes against the grain, i.e. they produce a forecast that's different to maybe the general consensus in the market for that particular business in question. How might this be mitigated? Inviting critiques, inviting people to give opinions on the forecast that you have produced, evaluating how your forecasts have been in the past, so whether they've been actually fairly close to the actual figures or not, and scenario analysis. So scenario analysis is where you produce a range of forecasts based on possible events, based on possible outcomes, and so you have a wider range of possible outcomes to consider. Illusion of control is related to overconfidence. So illusion of control is overestimating what an analyst can actually control or trying to control what they can't. So for example, trying to make a forecast more complex than it maybe should be by including more independent variables, thinking, well, if I include another one, I'm getting this to be a more accurate forecast, and that's not necessarily always going to be appropriate. Another alternative to that would be seeking expert opinion, so essentially seeking an opinion which is trying to confirm or agree with the forecast that you have produced. So trying to seek out an expert opinion that you believe will make your forecast more accurate than anyone else's. Mitigation, only relying on variables which have an explanatory power, so not inputting additional variables, making it a more complex model just for the sake of making it a bit more complex, and also bringing in opinions but only from those who actually have a relevant perspective on the entity in question. Conservatism. This is where new information comes to light. Now, often this will be negative information because generally speaking, an analyst would probably be willing to incorporate positive information. But where new negative information comes to light and the analyst is unwilling or hesitant to incorporate this into adjusting forecasts. Sometimes also known as anchoring, so it's anchoring to an initial opinion or initial forecast that has been produced. This can be mitigated by periodically reviewing forecasts, reviewing errors that have occurred in the past, and again, trying to simplify the model that is being used to reduce the number of independent variables. This can be seen with positive information, so there could be a lag in incorporating new positive information. It's just more common with new negative information because people will be more reluctant to include it in their forecasts. As I said, we've got 2 more biases on the next slide. So representativeness bias, tendency to classify per past known classifications. So the idea behind this is having an understanding of what is happening in the business and how to appropriately treat it. Now, this could be an understanding of how it normally affects the industry, And so therefore, assuming that that's going to be exactly how it affects this business going forwards, without thinking about the company's specific information. So it's using knowledge that you have from the past and assuming that that's going to be the appropriate way to classify, the appropriate way to incorporate this new information going forwards, when that's not necessarily always the case. This generally happens when mentions the base rate here, so that kind of base level of understanding focuses on that outside class characteristic, i.e. how it impacts an industry rather than this specific company. Of course, the mitigation to that would be when you're generating a forecast to consider both what happens externally and internally within the business. And then finally, confirmation bias. So you have produced forecasts and you seek out information which agrees and validates with those forecasts rather than seeking out information which may or may not agree. So choosing to place more of an emphasis on new information which validates forecasts you made earlier. Of course, as an analyst, you should be trying to seek out a diverse range of information. Some may agree, some may disagree with previous forecasts, and you may need to adjust forecasts going forwards as a result of this. So that's a brief look at biases. As I said, when you look at the portfolio management topic area, we'll be having a look in more detail at investor biases. These biases focusing here in terms of the definitions and mitigations on the analyst side of things. Our next little section to cover is about Porter's 5 forces. So this is looking at the competitive positioning of a company and how this is affected by prices and costs. So Porter's 5 forces, funnily enough, has 5 different elements to it. We'll have a look at all 5 of them. The first element we consider is the threat of substitute products. So what is the risk that customers go and buy a product elsewhere rather than with you? Not exactly the same product, but a substitute product. So in the travel industry, for example, this could be the risk that someone takes a bus rather than paying for a taxi. And companies have less pricing power if the threat of substitute products is high. So what that means is if there is a high risk that customers can use a substitute product with essentially the same outcome, if you're taking a bus or a taxi, the main goal of your spending your money is to get to your destination, presumably. If the threat of substitute products is high, then a company would have less pricing power, i.e. they have less control over what price they set, because it is likely that if they set the price too high, customers will go to that substitute product instead. Especially true if switching costs are low, i.e. there's not a certain level of loyalty within this industry. People haven't signed up for long-term contracts. It's not kind of a brand recognition type of industry. It is easy for customers to switch from one to the other. So if substitute products is high and switching costs are low, then a company does not have a huge amount of a say over the price that they charge if they want to be successful. Next up, we have a look at competitive rivalry, or the intensity of industry rivalry. So this isn't looking at substitute products, this is looking at a product which is essentially the same. So rather than buses versus taxis, this would now be having a look at different taxi companies within the same town or within the same city. Well, if the intensity of rivalry is high, i.e. there's a lot of different taxi companies, then each company in turn will have less pricing power. They have less control over the price that they set if they want to be successful compared to competitors. So pricing power, it says here, is low. Pricing power is low when industry concentration is low. When fixed costs and exit barriers are high, when industry growth is slow or negative, and when products are not differentiated to a significant degree. So let's just break that down a little bit. We'll start at the end actually. So when products are not differentiated to a significant degree, i.e. they are similar. Well, if the products are similar, again, that means that for the majority of customers, they're probably not going to mind too much which one they purchase. And so therefore, price is going to play quite a big factor of their decision. Pricing power therefore being low, i.e. the entities who are selling these products or services can't just charge whatever they want. This, of course, is all related to the elasticity of demand as well, the price versus the demand. Industry growth is slow. If industry growth is slow or negative, then that means generally speaking, the only way to increase revenues within your business is going to be to steal customers from competitors. If the industry growth is slow or negative and there is some kind of competition, then if you put prices up, customers are likely to go elsewhere. You can't generate new customers by bringing new customers and increasing volumes into the market. Instead, the only way you can increase volumes for your specific company is to steal the customers essentially from other competitors. Fixed costs and exit barriers are high. So that's not thinking about the customers now, but that's thinking about the entity itself. If they have a high level of fixed costs and it's difficult to get out of the business, exit barriers are high, then it's going to be crucially important that they generate enough volume to cover these fixed costs and exit barriers. And again, if they put their prices up too much, this will lead to a decrease in volume, which overall may mean they struggle to cover fixed costs and exit barriers as well. Industry concentration is low. Well, if industry concentration was high, that would mean that there were only a couple of different entities within the industry, each of them with a large market share. Industry concentration being low means there is a low market share per entity, which again is going to signal that each entity in turn doesn't have a huge amount of control over the pricing power it sets. So we said that there were 5 in total. We've covered 2. Next up, we're thinking about the bargaining power. So the bargaining power of suppliers and the bargaining power of customers. Essentially, where does the power sit? So if suppliers have a high level of bargaining power, that means that the suppliers are able to have quite a lot of control over the terms and agreements of contracts, over the price they charge. And what that generally means is the entity who is purchasing from the supplier is likely to have to pay higher prices. They don't have as much say over the terms of the contract, and their earnings growth is likely to be lower, or the earnings potential is likely to be lower. Why? Well, if you need to buy maybe a specialist item and there are only 1 or 2 suppliers in the market who can produce it for you, those suppliers have a lot of power over how much they charge. If instead you were buying quite a general item and you could choose to buy it from 200 different suppliers, then the bargaining power of the supplier would be quite low, because you'd be able to compare all of the different contracts and find the one that best suits you and negotiate to offer that supplier your custom. Similar with customers as well. So if the bargaining power of customers is high, then that means the customers have quite a large say over the terms of the contract, over the amount that they are willing to pay. That's going to reduce the pricing power for the company who is selling the item. The company selling the item is going to have to listen to the customers if they want the business. In terms of when bargaining power of customers is likely to be high, that is often where there's a small number of customers. So it's often where there's a small number of customers. If I set up a supermarket, a grocery shop, and I sell items, then every single customer who comes in doesn't necessarily make up a huge proportion of my sales, assuming I have lots and lots of customers. If, however, I am the ultimate producer of a food product and I sell it to 2 supermarkets, and that's it, then each supermarket is going to have quite a lot of power. They are my customers, and they're going to have quite a lot of power over how much they pay, the quantities, terms, etc. It also depends how easy it is for customers to switch. So if it's easy for customers to switch between their suppliers, then that's going to push more of the power into the customer's hands. And then finally, Porter's 5 forces, the final point here, the threat of new entrants. So we've talked about competitive rivalry, but what about new competitors coming in? So you might have 4 competitors at the moment, but how likely is it that new competitors are going to come in? If it looks like an attractive market, you are going to get businesses trying to start up. If the threat of new entrants is low, so it's unlikely new businesses are going to start up because maybe it's very expensive, there's a huge amount of capital investment required, or maybe there's a lot of regulation around the industry. If that threat of new entrants is low, then the companies who already exist in that industry will have a bit more pricing power because it's keeping the number of competitors down. So that's having a look at Porter's 5 forces. That's going to be important when you are forecasting financial statements going forwards, because you need to understand what's happening in the wider industry as well as your specific entity. So the next section of this video is having a look at the impact of price inflation. We've got a couple of points to consider here, and then we will work through an example. So generally, in most economies, we see price inflation. So we expect there to be inflation in supplies for businesses, and then it's thinking about, can you pass that inflation on to customers in the selling price? If a firm has a commodity type input, then they can hedge that exposure. So if they are buying commodity type purchases, then they can potentially hedge that exposure. So we're thinking about things like using derivatives, or it might be just entering into a fixed price contract for a set amount of time, and so confirming and agreeing with the supplier that your price won't increase. If you are looking at a vertically integrated firm, then they are less affected by input cost price inflation. And what we mean by that is, if it's vertically integrated, they are essentially their own supplier. So let's say you've got a restaurant, for example, but instead of buying in the food, most of it they grow themselves, then whilst they might experience some price inflation, of course, a lot of their raw materials that they're using, they are growing themselves. They're going to be suffering that a lot less than if they were having to buy the raw food in from other suppliers. Now, when we're building this into forecasts, you need to have a good understanding of the business to judge whether the price increases a company are facing on their supplies, you believe they can pass on to their customers or not. So you need to understand what's happened in the past, the type of customers, what's happening in the industry, what are competitors doing, etc. And the effect of increasing a price, the selling price of an item, is of course going to depend on the elasticity of demand, which we mentioned earlier, and what rivals are doing. So let's take a look at a couple of illustrations. We've got Alfredo Inc.'s income statement here. So this is at the moment in X1. Revenue, they sold 1,000 units for $100 each. Those 1,000 units cost $40. So you can see that getting down to a gross profit. We've got SG&A getting down to operating profit, and we've just worked out the gross profit margin operating profit margin at the bottom. Now we're forecasting here that for X2, cost of goods sold will increase by $5 per unit. So instead of them being $40, they will go up to $45. And we want to think, well, what might the income statement look like? And we're going to think about this under a few different scenarios. So the first scenario, the entire input cost increase, i.e. the $5 increase, is passed on to customers through an equal dollar increase in the selling price. Well, the selling price was originally $100, so adding the 5 on, we're saying that the selling price is now $105 and cost of goods sold is $45. So they're passing the full amount on, And we are told, let's assume that units sold is not affected. So the units are still going to be 1,000. And you can see here. So we can see that the gross profit figure is still 60. SG&A is not going to change. We're assuming that that is fixed. And so we have the same operating profit and the same gross profit. The gross profit margin and operating profit margin are going to be a little worse. Why? Well, because the denominator, of course, for these is the revenue of 105, whereas previously it was 100. So actual figures for gross profit and operating profit are the same, but the margins are slightly worse. Let's have a look at another example. So we are going to increase the selling price by 5%. So that is the same $5. Because we're still looking at X2, it's just another possible outcome for X2, but the units sold is going to decrease. So originally the units sold were 1,000, they're going to decrease by 5%, so times that by 95%. So we've got the increase in the cost of goods sold, that goes up to 45. The revenue, yep, they're still passing that on, but here the price increase hasn't gone down so well with customers and the units sold has decreased. We can see that gross profit has declined. Previously it was 60k and now it's 57. SG&A again we're assuming is fixed, so of course that has an impact on operating profit too. That was 30k before and it's now 27. So again, it's just demonstrating possible outcomes, and as an analyst you'd then need to think about what's happening in the industry, what's happened in the past with price increases to decide the likelihood or the probability of each of these outcomes. So again, you can see the gross profit margins at the bottom have been affected by this. And the final scenario, the worst case, they are going to pass the price increase on, but units sold have decreased by 10%. So now instead of the 1,000 units, it's 900 units which have been sold. We know the revenue and cost of goods sold per unit. And again, we can see. So in the previous example, gross profit was 57, and in the one before that, it was 60. Same with operating profit, 27 and 30. So you can see that this is the worst case. And again, the gross profit and operating profit have been affected by this. Now, of course, there's many other scenarios that you could consider as well. So you could consider, well, what if they don't pass the price increase on? So the gross profit they're going to make per unit is going to be $5 less, but what impact might that have on volumes? And you might look at the industry and realise all the competitors are going to pass the price increase on. So actually, if this company doesn't, they might see volumes increase. So that's another scenario that you could do. We haven't done it here, but it's another thing to consider. Finally, the last slide of this video is thinking about, well, how long should I forecast for? Once I've got all of this information and I know what my expectations are, I'm making sure I don't have any biases, I've thought about inflation, how long should I do this for? Now, if you are looking at this from an investment perspective or an analyst perspective, you might do this based on the expected holding period. So if you have a portfolio where the annual turnover is 25%, for example, that means that on average, you're turning over a quarter of the stock each year. You expect, therefore, on average to hold a stock for 4 years. So it might be that you look to forecast for the next 4 years. Of course, if you have more detailed information about the holding period for this particular stock, that's where you'd be looking at the forecasting horizon. If you have a cyclical firm, so one where you expect the earnings to really vary over several periods, then it is important that you don't just use the years where they're doing particularly well or the years where they struggle a bit more, and you should include some mid-cycle in there as well to average out and flatten out those earnings. Of course, if you're aware that there have been some recent large events happening in the business, so acquisitions, mergers, restructurings, etc., then of course that's going to adjust your forecast going forwards, and you should ensure that you forecast for long enough to see the benefits of that come to light, or not come to light if actually the acquisition was maybe not such a good decision. Now, I'm saying all of this like you have a choice. It of course depends on your firm's policies, and it might be that the forecast horizon is just dictated by the analyst's manager or by policies in the firm. Why are we forecasting? Well, ultimately, as an analyst, we're forecasting to get a good understanding of what we expect the business to do going forwards, which will help us make decisions over whether we wish to buy, sell, hold these investments. And the main purpose of doing that is by looking at how much we value the stocks at versus how much they're actually trading at. Now, there's various methods of valuation, and you'll look at this in a lot more detail in your equity investments topic area. But a couple of examples would be a multiples approach. So for example, price to earnings, or your PE ratio, which is looking at the ratio between a share price and the earnings of the business. So of course, if you're looking in future years, you can use those future earnings and estimate how much you think the share price might be trading at. Discounted cash flow approach. So this is looking at all the future cash flows you expect for this business, and it discounts them back to the present value, which is a reflection of how much you think the stock is worth today or whichever date you're discounting to. Of course, there are things to consider here. Your forecasts, well, your valuation is only going to be as accurate as your forecasts are, and also what appropriate discount rates there are, so the required returns, for example. If you are using something like a discounted cash flow approach, you also need to be very aware of inflection points, and that is where something changes in the business which signals that the future performance of the business is not likely to be like the past. So something like a large acquisition or a merger. And of course, that's going to have a large impact on the cash flows you forecast and therefore the valuation you produce. That brings us to the end of this video. So we've covered quite a few different topic areas in this module. I hope you found that useful, and best of luck.